Hello, my name is Courtney James with Acuity Advisory Corp. And today's Mighty Minute, we're going to be chatting with John Burke, newsletter writer and investment advisor representative at TWPM. John, thank you so much for joining me today.
Good to be here, Courtney. Thanks for the invite.
Yeah, this is our second interview where I get to learn a little bit more from you, so I really appreciate it.
Yeah. The last one was
Um,
timely on uranium.
Exactly. And now today we're going to be talking about John's latest newsletter update, which focused a lot on gold. So I'll make sure to include a link to provide options to subscribe to his newsletter for those that are interested in his insight. But before we get into that, for those who don't know, John, could you just give a little bit of a background on yourself and your experience in the sector?
Yes. From the mop of white hair, you can tell that I've been around a little while, and I've been in the business quite a few years, over half a century actually, and have witnessed several inflation gold cycles through my career, going back and I've lived through the biggest of all inflation battles back in the 1980s, when gold really started to soar. And we could very well be on the cusp of that type of thing again. But again, most of my career was spent in the investment business at brokerage firms. In 2004, I founded my own investment advisory firm, Starboard Asset Management, and recently have joined TWPM, another advisory firm, as an advisory representative.
Amazing. So jumping into the newsletter that you put out most recently, which relates to gold and the direction that it's moving currently, can you elaborate on the factors that contributed to gold's recent $35 breakout and its significance in surpassing the 2000 mark?
Yes. The last letter pertains to the major reason for owning gold as a hedge against inflation. Now, what I did in the weekly this past week was to look at the ratio of inflation via the CPI index to gold by simply dividing gold into the movement of the CPI. And in addition to that, there's an addendum chart that shows the S&P in the same relationship. That is the S&P divided by inflation. Now, the important part and why gold broke out last week is really part and parcel of the whole inflation story. And that story has been with us for quite a few years now in the press. And the frustrating thing, I think, toward gold with most investors is it has not responded on a shorter term basis to what has transpired with inflation. Mm-hmm. And you say, well, if it's a hedge against inflation, why isn't it moving? Well, there are certain short-term barriers, such as higher interest rates and a stronger dollar that go along with those higher interest rates, that create barriers for gold to move. And that 2,000 share price barrier has been really one that has been with us for, I guess, well over a decade now. We got to those levels back in 2011, and then, of course, had a decline. But recently, it has challenged that 3 different times and hasn't gotten through. It's interesting to note, and this week, I'm going to look at gold in relationship to the foreign currencies. It has broken out in many of the foreign currencies, but not in the dollar. So again, getting back to the inflation aspect of why gold is breaking out or why it's going to break out, is that once the inflation starts to take its damage or take its toll on the market, what then transpires is the stocks start to become affected by that increase in inflation, because it affects their profit margins. It affects the all types of issues within corporations. Well, when the stock market starts to finally decline from the aspects of inflation, you then get an opposite effect taking place with gold. Because as long as the money is flowing into the stock market, it's not going into gold and or commodities. And last we spoke, we talked about commodities and some of the effects on commodities. And gold is what I like to call king commodity. It leads the way. Oil is the most utilitarian of all the commodities, and it often is a strong signal of a continuation of inflation, and that, of course, has been on the back burner price-wise here of late. But once that starts to take off, we're going to probably see renewed inflation. So the likely aspect of inflation continuing with a declining economy or declining corporate or stock market is going to be the potential setup for stagflation. So, but suffice it to say, without going on and on and on, inflation is the reason we are having the breakout, and inflation is not going away anytime soon. And the charts and I like to show charts or the technical aspects of a particular report that I do, and then in turn show the fundamental reasons why that chart is doing what it's doing. But it's pretty clear from the two charts that I presented, gold versus inflation and the S&P versus inflation, that gold is definitely moving in a positive direction versus a negative direction of stocks versus inflation. So stocks are losing ground and gold is gaining ground. So they're both very important to what is likely to transpire here in the upcoming year.
And, I know looking back last year, I did hear a lot of people saying similar concepts, saying that gold is going to be the safe haven against inflation, and gold was the best way to hedge against this upcoming inflation. But we didn't really see that play out last year. Why do you think that it's more imminent this year?
Well, it's more eminent because the likelihood of the interest rates that I mentioned previously that have been the barrier, one of the serious barriers because you have to remember that gold doesn't pay income. It doesn't pay any dividends, where bonds, on the other hand, do. So if bonds are rising and the interest rate that bonds are paying is rising, investors, especially larger institutional type of investors, are more prone to go in that direction.
Right.
So as those interest rates start to decline, and when we see the first Fed interest rate decline, which some people were back and forth against as far as when it's going to occur next year, we will see gold really take off, in my view, because it doesn't have that roadblock staring it in the face any longer. And if you go back and look at history, look at the last time we had a huge surge in gold back in 11 through 8 and 11, the same type of situation transpired. You had gold do poorly during the top of or the declining part of the market, and then once the Fed started coming back in and lowering interest rates to try to get the economy going, now you're dealing with a new bout of inflation. And that new bout of inflation is what is really going to light a fire under gold.
And do you see the rise in the price of gold impacting a lot of junior exploration companies or junior mining companies that have been having a difficult time in the market lately?
I most certainly do. And they are going to be, I have a small allocation in that area now, but they are likely to be one of the major beneficiaries. And especially at this time of the year, many of those stocks have been severely depressed. And that depression only gets worse at the end of the year in the United States with their tax code, where people sell things that are in their portfolio at a loss and may repurchase them in the next year. Well, in the case of the states, you have to wait 30 days. But at the end of the year, that tax loss selling pressure is taken away. And these depressed stocks no longer have a selling cloud over them, if you will. And once that cloud lifts, you oftentimes see somewhat of an explosion. They light up like a Christmas tree, I like to say, after the first of the year. And I think we're likely to see that take place in many of the junior miners. It starts to originally take place, and we're seeing some of that right now. If you look at stocks like AEM, which is Eagle, Newmont, these are stocks that the institutional investors generally buy, the large capitalized gold companies, and they're starting to move. And they will, when they continue their movement, as I believe they most definitely will after the first of the year, that's an indication, in my view, that the institutional investors are starting to move. And the other key aspect of gold and the juniors and the whole precious metal group after the first of the year is when the stock market starts in the other direction, if and when that happens. And again, I think you're going to likely see that take place. What that provides is an enormous amount of capital. One of the other charts that I've used numerous times over the last year is the combination of looking at gold versus the Standard & Poor on a ratio basis. I'm a great fan of ratio charts because one
I've
thing
noticed
at one chart, but when you compare the chart to something that's really meaningful, like gold to the stock market, you get a much more meaningful outcome, I think.
Yeah.
So one of the major charts I've been telling investors to watch is the relationship of gold to the Standard & Poor. And it's almost a 2-to-1 type of relationship. Gold's at 2,000 and the S&P's at what, 4,400 or thereabout. And when gold starts to break out versus that S&P ratio, and it's been as high as 52 in the last year. But when it breaks that 52 level and really starts to take off, we now have a situation that is telling us that the shift to gold and commodities is going to go in its favor, away from the markets, because that money that is in the markets will start to move in that direction. And gold is such a tiny part, precious metals in general, or in the mining industry, is such a tiny part of the investment picture that when money starts to flow in that direction,
in massive amounts,
it lights up like the Christmas tree, as I said. It really can. So I think we're very possibly looking at that type of situation developing early in the year.
And so if you are, talking to somebody who's looking to benefit from what these trends are predicting, would you recommend that they diversify and maybe put some of their money into some of these junior companies, some of these more established companies, and then maybe physical gold as well? Or how would you, what would be like a rough recommendation for individuals looking to benefit from this?
Okay, I have I'm obviously a bull on gold and have been for some while, but diversification, as you're indicating, is a very, very important aspect of any investment. I believe you can have as much as 50% allocated to precious metals in a portfolio.
Right. Wow.
Okay. However, you don't want it all in juniors. You don't want it all.
As fun as that can be, it's
it could be a lot of fun, and you
could also have a heart attack.
Yeah. But in the meantime, right now, if you're in that position, you're not a very happy camper. You're losing a great deal of money. But
I'm sure they're quite happy to hear about this Christmas tree philosophy. So
okay, well, looking at gold from what I call a 5 diversifier category. I like to put about 10%, look at 10% in the actual metal.
Right.
And I use the market vehicles. I'm not a big fan of the GLD, but there's a couple. Sprott has a couple of entities in the precious metal ownership area where they own nothing but gold and silver. One of my favorites is Sprott. I forget exactly what they call it. I can give you the symbol, but I can't think of the name of it. CEF is the symbol, where they have 30%, roughly 30% in silver, and the rest is in gold. Actual metal, not equities, metal.
Okay.
So there's the 10% allocation to gold or precious metals and silver. Now, my second category are the streaming companies, royalty and streaming companies, because they own the actual metal,
right?
And they own it on a low risk basis, where they don't have a lot of the risk that are associated with mining,
Right.
The inflationary risk, the country risk, and so on. As one of those companies recently found out, Franco-Nevada had a very large 17% interest in a Panamanian mine, and the government decided to step in and not allow them to do what they had originally agreed with, and the stock has just gotten trashed. But the important part, the point that I want to make there, is they don't have the risk, and they also have the metal in place, so that they're leveraged very nicely to the price of silver and gold or whatever commodity they're involved in. So royalties are the second area. And then silver. I think silver is a very, very important component of the precious metals. And I think you would have at least 10% allocated into that area. And then I start looking at the production companies, those that are actually producing. And there's some amazing bargains out there.
Wow.
You can look at any number of these companies that are what you would call value stocks. They're selling at 10 to 20 cents on the revenue dollar. They're selling one that I own at about 2 times its EBITDA, or every year it's producing pretty much what its total capitalization is. I mean, they're insane valuations, and they have enormous potential or leverage to the upside of gold. And then I think that's 4 categories. The 5th would be the juniors, or the explorers, the exploration.
Right.
And you want to have maybe a 5 or 10% allocation in that area. But
so you're saying roughly 10% into each of those categories.
Yeah.
Okay.
Yeah.
And then the other 50% of your portfolio away from precious metals and something different. Okay.
Uranium, as we discussed the last time, should be a big component. Energy should be a big component.
Right.
Right now, there's a lot of interesting values around in the oil and gas industry that can be looked at. And later, the food commodities and fertilizers and that type of group. I think I believe they have some very interesting potential going forward. And the rest of the portfolio, in my view, should be in that position. No S&P stocks, no 60-40 relationship, 60% in stocks or 40%, because both of those areas, I believe, going forward, are going to do poorly. Right. And they will start to reflect the inflation, the intense inflation that we have ingrained in not only the U.S. system, but the worldwide system. And the dollar, being the major currency, has exported inflation to all countries. So
amazing.
So that's a diversification story that I think could work. I believe could work very well next year. It's not without risk.
Of course,
the government can keep on pumping money into the system and keep it going and keep the stock market happy, and we'll have a similar situation to what we had last year, a volatile up and down environment. At some point that's going to change, and when it does,
but logically it should follow this trend. But when there's hiccups or disruptions, then that can just change it.
But,
amazing. Yeah, well, thank you so much for
You're welcome.
breaking down your last newsletter. Once again, I will be sure to attach a link to this so that people can view it if you would like to. And then I know, John, you recommended some interesting companies. I will provide information about that in the comment section below if anyone wants to check some of those out. Um, and this isn't buying advice. This is just an exploration of options that are available. So I really do appreciate your insight into it.
Okay. Thank you, Courtney. It's always a pleasure.
Yeah, we'll do this again soon. It's always
Okay.
great.
Thank you. And if I don't see you before Christmas, have a very, very nice time. A very
You,
happy holiday. Right?
thank you. I appreciate that.
Okay.
You as well.
Thank
Bye.
you.